Hello everyone and welcome back to another episode. My name is Jordan, the Millennial Investor, and today we're going over a company. Now this company has been a core holding in my M1 Finance dividend growth portfolio, and it's a great dividend stock. I consider it a core holding, and as of late it has been at a lower target percentage than it normally is in the portfolio. Only at 2% of the target weighting right now, but this has ranged anywhere from about 1 to 7% of the portfolio ever since I started showing this and disclosing my portfolio in April of 2020 when I started making these videos right here along this monthly chart. Now, when I originally started this, I had way less money and way less impact on the market, and honestly, I wasn't as knowledgeable back then as I used to be, but nonetheless, it has been a core holding, and it's one I want to address. I don't know how long it's been since I made a video just about Procter & Gamble, so I want to talk about this company in this video. There's so many times that we look over things in the markets, and things just can get a little blurry. You look at headlines, and you just log on to the CNBC. Let's go ahead and log into that. You log into CNBC and you see all types of news, all types of updates. Nvidia stock falls after the US government restricts chip sales. You see Sam's Club raising its prices. You see Jeremy Grantham predicting all of his bubble territory predictions and buy my gold because I'm incentivized to do so. You see that every single month, every single year. But nonetheless, if we bring it back to the basics and we look at Procter & Gamble and this company's long history of outperformance, I think it will lead us to show how just simple, boring investments can sometimes lead to outperformance. But if you haven't seen me before, my name is Jordan, I'm a Millennial Investor, and I share this portfolio down below in the description, which is right here in this link. And if you want to check out other things down below in the description as well, including Yada savings accounts, credit card referrals, swag bucks, all types of good stuff like that, check that stuff down below in the description. You'd help support the channel and I would really appreciate it. We've had 124 people try out M1 Finance so far using my referral link, so check that out if you're interested. And without further ado, let's go ahead and get started with Procter & Gamble. Now let's talk about this company's long track record, and I mean long track record of growing revenues and growing profits. You can see that this company just continues to have revenue and profitability just go up and to the right. Going back to 1986 doing $15 billion in revenue versus today's $80 billion in revenue. Over the last couple of decades, this company has continued to slowly grow as it's acquired more brands, raised prices, and really flexed that pricing power that a consumer staple like Procter & Gamble has. Now furthermore, the profitability has done the same. If you want to take a look at EPS, which is earnings per share, this goes back to 86 when it was 27 cents, and today's it is now at $5.81, a dramatic uproar in earnings per share. Same thing if you look at other metrics like free cash flow, about $0.7 billion back then, and today it's at $13 billion and change, and you get the point. Overall, this company continues to produce revenue, produce profits, and then of course use those profits to buy back shares ever since they did that big acquisition in 2006 from about 3 billion shares outstanding or so, versus today's, if we go to the most recent quarter, from 3 billion shares down to today's 2.5 billion shares. So bought out 500 million shares back since that acquisition in 2006. Now, what does Procter & Gamble do? What do they actually sell? Is this a company that you know? Well, the funny thing is when I tell you Procter & Gamble, if you're not big into the dividend investing space, it may or may not ring a bell. But I want to go through some of these brands and you tell me if you recognize this company or not. Because once I start to go through all the different names, you're going to say, holy crap, this company's in everything. So let's go ahead and take a look. We have All Good, Charlie Banana, Love's, Pampers, Ariel, Bounce, Cheer, Downy, Dreft, Era, Gain, Rendex, Tide, Bounty, Charmin, Puffs, Always, Always Discreet, Just, Tampax, This Is L, Braun, Gillette, Joy Plus Glee, Gillette Venus, The Art of Shaving, Aussie, Head and Shoulders, Herbal Essences, My Black is Beautiful, Old Spice, Pantene, Ambipure, Cascade, Dawn, Febreze, Gain, Microban 24, Mr. Clean, Salvo, Swiffer, Zevo, Crest, Fixodent, I've never actually heard that one, Oral-B, Scope, Align, Clear Blue, Meta, Pepto-Bismol, Prilosec OTC, like those stupid commercials you see with Shaq on them all the time, Vicks, ZzzQuil, and you get the point. It just keeps going. We're basically to the very end. But you get the point. This company has many many different brands that I'm sure many of you know and see and buy every single day. Now, these brands, as you know, since they're all household names, they're things that people have gotten accustomed to buying. They have recurring revenue in the sense that people continually buy them, discard them, and buy them again. For example, I'm passing Tide. That's laundry detergent. That's something that pretty much everyone needs. Same thing with Bounty paper towels. You use the paper towels, you throw them away, you go back to buy more. I'm looking at Gillette and Venus. That's something that you have to continually buy. As your deodorant runs out, you go back and buy more of it. You get the point. All these are household staples that you have to buy every single week, every single month, every single year. And obviously, every time you do so, you're getting that profit in the pockets of Procter & Gamble shareholders. And this is what leads a lot of dividend investors really to be attracted to this company, because they're so ingrained with every function of your household on basically every brand that you see, that it's really hard for this company to ever see a scenario where they will go to zero or go bankrupt. So that's what leads this company to continually grow its revenue at a massive scale, and they're so large that profitability just comes naturally. If you look at their return on capital employed, other than this one time when they wrote off a big part of their Gillette investment, you can see that consistently it's slightly trended upwards, but their ROCE is generally around 4 to 5%. If you look at their profit margin, generally going in the right direction other than that one hiccup quarter, generally floating around 8, 9, 10, and now even in recent years as high as anywhere from 16 to 20%. So not only is this company getting bigger, but they're getting more efficient as the profit margins are growing. So if they grow revenue, say 10%, then more than likely the profits are going to grow more than 10% as they get more efficient and grow those profit margins. But the thing is that when you look at this, I'll put up a hypothetical investment going back to 1985 into today's 2022, and let's change this. Let's include year to date. So we'll even show up to today's performance. But what it is just a $10,000 investment back into 85, and the key part here is we're reinvesting dividends, because not only does this company's share price typically go up over time, as you can see from its all-time chart here. If you look at a 1-year performance, it's shaky. If you look at a 2-year performance, it's flat, 0%. 5-year, starting to get a little decent, 49%. 10-year, it's over doubled. Okay, now we're getting somewhere. And then the further you zoom out, if you look at the all-time performance, it's up 9,500% off just a basic household company, everyday products that you take for granted and you don't even think twice about. And if you look at that, does this company beat the market? Would this be better if you just invested in the S&P? Well, according to this calculation, the answer is no. If we take off logarithmic and we look at the total CAGR here, the S&P 500 during that time returned 9.91, while Procter & Gamble returned 11.01. So beat out the S&P by about 1.1% or so. This is pretty steady returns for a basic boring company, while more importantly, having less volatility than the S&P 500, which is crazy because you look here, the max drawdown was greater for the S&P than Procter & Gamble. So it's sometimes boring companies like this that can perform the best, and the main reason is since it's a massive dividend growth company, what really starts to set this company apart as we get further along, you see it's pretty much tied here for years, and then it really starts to diverge around the early 2000s and especially going into the last decade or so, and that's because this portfolio income is what sets you apart. This $10,000 investment in 2021 would have produced $2,000 in income from the S&P, but almost $5,000 in Procter & Gamble. And it's dividend reinvestments like this what makes incredible investments. And sometimes, guys, it doesn't have to be complex. It doesn't have to be very well thought out or revolutionary or have super innovative products. Sometimes it's just basic household investments that can lead to very profitable returns for you as an investor. Thank you guys so much for watching the way, and I appreciate you watching and tuning in. Subscribe if you haven't already. Check out all the stuff down below in the description, and I'll catch you guys next time.